Good morning, Forex traders, and welcome back to Market Meridian Finance, your trusted source for no-fluff, data-driven analysis to turn market moves into profitable trades. Today is April 21st, 2026, and we're diving deep into a relationship that every Aussie dollar trader needs to master, the US dollar index and how it dictates the direction of the Aussie. If you've ever watched Aussie and USD swing wildly and wondered, what's driving this? The answer, more often than not, is the USD index. Today, we're turning that knowledge into action. I'll show you exactly how to use USD index's moves to trade the Aussie dollar profitably, right now, with real-time charts, key levels, and 3 actionable trade setups tailored to today's market. Let's get started. No jargon, no guesswork, just results first. Let's make sure we're all on the same page. The US dollar index is the backbone of global currency markets. It measures the US dollar's strength against a basket of 6 major currencies: the euro, 57.6% weight, Japanese yen, 13.6%, British pound, 11.9%, Canadian dollar, 9.1%, Swedish krona, 4.2%, and Swiss franc, 3.6%. Now, the Aussie dollar, officially the Australian dollar, AUD, is what we call a commodity currency, meaning its value is closely tied to the price of Australia's top exports, like iron ore, gold, and coal. But here's the key: even with its commodity links, the Aussie's biggest driver between USD index and Aussie and USD trading, a correlation that's held strong for decades, and one that's especially powerful today. First, the US dollar index 30-minute chart. This is your Aussie trading compass for today. As of right now, DXY is trading at 97.962, up 0.04% on the day, with a session range of 97.400 to 98.182. Let's pass the technical step by step, because every detail here will tell us what the Aussie is likely to do next. First, moving averages. The 5-period MA, yellow, 97.958, is just above price. The 10-period MA, blue, 97.952, is flat, and the 20-period MA, pink, 98.010, and 40-period MA, red, 98.095, are sloping slightly downward. This tells us the short-term trend for DXY is neutral to bearish. The dollar is stuck in a narrow range, with price action hovering below the longer moving averages, signs that bullish momentum is fading. Next, the MACD. The MACD histogram is in negative territory, but the red bars are shrinking, and the signal line is starting to curl upward. That's a hint that bearish momentum is slowing down. We could see a short-term bounce in the dollar, or at least a pause in the recent sell-off. Finally, price action. USD index hit a low of 97.400 in the early hours of April 21st, and has since been consolidating between 97.900 and 98.200. This consolidation zone is critical. It's where the market is deciding whether the dollar will weaken further or stage a comeback. And every move in this zone will directly impact the Aussie dollar now. Let's flip to the Australian dollar to US dollar 30-minute chart, and notice how it's a near-perfect mirror of DXY's moves. As of right now, the Aussie is trading at 0.7176, with a slight decline of 0.0139% on the day, a session high of 0.7177, and a low of 0.7171. Let's connect the dots between USD index and Australian dollar to US dollar, because this is where the magic happens. First, Moving averages, the 5-period MA 0.7175, 10-period MA 0.7174, and 20-period MA 0.7172 are all flat, with price hovering just above them. This matches DXY's neutral trend. The 40-period MA 0.7168 is sloping slightly upward, which tells us the longer-term short-term trend for Australian dollar to US dollar is still bullish, but losing some steam. Next, the MACD. The MACD histogram is in positive territory, but the green bars are shrinking, mirroring USD index's fading bearish momentum. This means the Aussie's bullish momentum is cooling off, and we could see a pullback if DXY bounces. Finally, price action. Australian dollar to US dollar hit a high of 0.7177 earlier today, right as DXY hit its session low of 97.400, and has since pulled back slightly as DXY consolidated. This is the inverse correlation in action. Every tick in USD index translates to a tick in Australian dollar to US dollar, and today is no exception. If you're only watching Australian dollar to US, the zones where USD index is most likely to reverse, pause, or accelerate, and they're non-negotiable for your trading plan. Let's start with USD index's support zones. These are the levels where the dollar could bounce, which would pressure the Aussie lower. First, immediate support, 97.900 to 97.850. This is the lower end of USD index's current consolidation zone, and it's a key level to watch. If USD index holds above 97.900, we could see a short-term bounce in the dollar, which would trigger a pullback in Australian dollar to US dollar. A break below 97.850, however, would confirm that the dollar's bearish momentum is resuming, which would be bullish for the Aussie. Second, secondary support, 97.400 to 97.350. This is the session low we saw earlier today, and it's a major support level. If DXY breaks below 97.850, this is the next target. A move here would be extremely bullish for Australian dollar to US dollar, potentially pushing the pair above 0.7200, a key psychological level for the Aussie. And now USD index's resistance zones. These are the levels where the dollar could reverse lower, which would lift the Aussie higher. First, immediate resistance, 98.200 to 98.250. This is the upper end of USD index consolidation zone, and it aligns with the 40-period MA 98.095. The dollar has failed to break above this level multiple times in the last 24 hours, so it's a key resistance zone. If USD index bounce, upward movement. Second, secondary resistance, 98.500 to 98.550. This is a key resistance level from the past week, and a break above here would signal a trend reversal for USD index. If that happens, the Aussie would likely sell off sharply, potentially dropping back to 0.7150 or lower. Now, let's translate these USD index levels directly to Australian dollar to US dollar, so you know exactly where the Aussie is likely to go. This is the most actionable part of today's analysis. Print this out, keep it next to your charts, and refer to it throughout the day. If DXY holds above 97.900 and bounces to 98.200 to 98.250, Australian dollar to US dollar will likely pull back to test support at 0.7160 to 0.7155. This is a normal, healthy retracement in the Aussie's current uptrend. If USD index breaks below 97.850 and tests 97.400 support, Australian dollar to US dollar will break above the 0.7180 level and target 0.7200 to 0.7210 next. This is a continuation of the Aussie's bullish momentum. If USD index breaks above 98.250 and rallies to 98.500 to 98.550, Australian dollar to US dollar will reverse its uptrend and fall back to 0.7150 to 0.7140. This would be a bearish shift for the Aussie, triggered by dollar strength. And if DXY consolidates between 97.900 and 98.200, Australian dollar to US dollar will trade sideways between 0.7165 and 0.7177. This is a wait-and-see scenario, perfect for scalpers looking to capitalize on small, quick trade setups for today's session, tailored to different risk profiles. Whether you're a scalper who likes quick, small profits, a swing trader who holds trades for a few hours, or a cautious trader who waits for clear confirmation, there's a setup here for you. All three setups are based on DXY's moves, so you'll be anticipating AUD to USD's moves instead of reacting to them. Setup 1, bullish Aussie play, if USD index breaks below 97.850. This is the primary setup for today, aligned with the longer-term short-term bullish trend for Australian dollar to US dollar. Here's how it works. First, the trigger, wait for USD and AUD break and close below 97.850 on the 30-minute chart. This confirms that the dollar's bearish momentum is resuming, which will act as a tailwind for the Aussie. Second, the entry, go long Australian dollar to US dollar on the break of 0.7180, or wait for a retest of 0.7175 for a better risk-reward entry. Waiting for the retest is smarter because it avoids false breakouts. You want to make sure the Aussie has momentum before entering. Third, the stop loss, place your stop just below today's session low, at 0.7140. This is a level where the bullish thesis would be invalidated. If the Aussie drops below here, it means USD index is bouncing, and the setup is no longer valid. Fourth, the targets. First target is 0.7200, the key psychological level, and the second target is 0.7210, aligning with USD indexes. Aussie's MACD is still in positive territory, so momentum is on your side. This setup has a risk-reward ratio of 1 to 2, meaning for every 1 pip you risk, you stand to gain 2 pips, which is a healthy ratio for any trade. Setup 2, bearish Aussie play, if USD index bounces off 97.900 support. This is a counter-trend setup, perfect for scalpers or traders. Zone, Australian dollar to US dollar will likely trade sideways too, and this setup is for scalpers looking to capitalize on that choppy price action. Strategy, buy Australian dollar to US dollar near support at 0.7165 to 0.7160, and sell near resistance at 0.7175 to 0.7177. Stop loss, 10 to 15 pips on each side, since range-bound moves are often quick and noisy. You don't want to risk too much on each trade, because the moves will be small. Targets, 15 to 20 pips per trade, taking profits before price hits the opposite end of the range. For example, if you buy at 0.7165, take profit at 0.7180. If you sell at 0.7177, take profit at 0.7162. Why this works? When DXY consolidates, Australian dollar to US dollar loses its trend and trades in a tight range. Scalping the support and resistance levels is the safest way to trade in this environment. You're not betting on a breakout, just profiting from the small, repeated moves within the range. This setup is low risk, high frequency, and perfect for traders who want to accumulate small profits throughout the day. Now, before you jump into any of these setups, we need to talk about the critical risk factors that could flip the script today. No trading plan is complete without accounting for the news and events that can override technicals, and today, there are 3 key factors you need to watch closely. First, US economic data. Second, risk sentiment. The Aussie is a risk-sensitive currency, which means it's closely tied to global stock markets and investor appetite for risk. If global stock markets sell off, e.g., the S&P 500, Dow Jones, or Asian equity markets drop, investors will flock to the safety of the US dollar, even if USD index's technicals are bearish. This could override the inverse correlation we talked about earlier, so keep an eye on global equity markets throughout the day. If stocks are rising, risk sentiment is positive, and the Aussie is likely to strengthen. If stocks are falling, risk sentiment is negative, and the Aussie is likely to weaken, regardless of USD index's moves. Third, commodity prices. Remember, the Aussie is a commodity currency, so it's also influenced by the price of Australia's top exports, like iron ore and gold. Today, iron ore prices are slightly flat, but any sharp move, up or down, could move the Aussie independently of USD index. For example, if iron ore prices rally, it could boost the Aussie even if USD index is slightly higher. Conversely, if iron ore prices drop, it could weigh on the Aussie even if USD index is lower. Keep an eye on global commodity markets, especially iron ore and gold, for clues that could impact Australian dollar to US dollar. The key here is to always use a stop loss, even if you're confident in the setup. The market is unpredictable, and these risk factors can change the game in an instant. Never risk more than 1 to 2% of your trading capital on any single trade. This is the golden rule of trading, and it will keep you in the game long term. Now, let's do a final recap of today's playbook, so you have a clear checklist to follow before you start trading. First, monitor DXY first, not Australian dollar to US dollar. Every 30 minutes, check USD index's price action against the key levels we mapped out, 97.900, 97.850, 98.200, 98.500. Second, wait for confirmation. Don't enter a trade just because price is near a level. Wait for a break, a bounce, or a candlestick reversal pattern to confirm the move. False breakouts are common, so patience is key. Third, stick to your stop loss. No matter how confident you are in the setup, never move your stop loss further away to avoid a loss. This is how traders blow up their accounts. Fourth, scale out of trades. If you hit your first target, move your stop loss to break even to lock in profits. This way, if the market reverses, you won't lose any money on the trade. Fifth, stay flexible. If DXY breaks out of its range unexpectedly, adjust your plan accordingly. The market is always right, don't fight it. Finally, avoid overtrading. Stick to the 3 setups we covered today, and don't chase trades that don't fit your plan. Quality over quantity is the key to profitable trading. Another thing to remember, the inverse correlation between USD index and Australian dollar to US dollar is strong, but it's not perfect. There will be times when the two move in the same direction, usually when there's a major news event or a sharp shift in commodity prices. But 9 times out of 10, the inverse correlation holds, and today, with USD index in a consolidation zone and Australian dollar to US dollar mirroring its moves, it's as strong as ever. Trust the correlation, but always use technical analysis and risk management to confirm your trades. If you found this analysis helpful, hit the like button, subscribe to Market Meridian Finance for more daily currency trading guides, and drop a comment below with your Aussie dollar and US dollar trade plan for today. Let's build a community of profitable traders together. Until next time, trade smart, stay disciplined, and we'll see you in the markets. Happy trading, everyone!